So good afternoon. I want to welcome everyone to today's Learn at Lunch webinar on the residual fertilizer deduction. We will learn from Extension Farm Tax Specialist, J.C. Hobbs, how this deduction works and can be used by producers. You may ask questions through the chat window by clicking the chat button at the bottom of the screen. You can find additional resources on this and other farm management topics on the eFarm Management page. I will share this link in the chat window. OSU Extension is offering a new webinar series starting tomorrow for beginning farmers and ranchers. We will substitute 2 of these webinars in April and May for our usual Learn at Lunch webinars. The April 16 webinar will cover enterprise budgets, and the May 7th webinar will cover e-commerce. I will share the link to register for these and other webinars in the chat window. JC, I will turn it over to you now.
Thanks, Brent. Well, this has become a very interesting topic that we're covering today. Over the last really about 8 months, I've received calls from producers. I've received some calls from extension agents in Oklahoma, educators. I've also had a chance to talk to a promoter on this topic of the residual fertilizer deduction and what can be done here. And so in the process of this, question came up, what should OSU do? How can we better help you as educators understand what's going on and your role in this and what maybe you want to do and don't want to do? And then some guidance that I've when visiting with Dr. Warren and a few others to discuss where do we really want to handle, how do we really want to handle this? So what's going on with this? Why is this thing occurring? And what takes place here is the IRS in materials that goes back into really about the late, I guess, early 60s, discussion of what happens when a farmer buys fertilizer, the and purchase applies, and the deduction that's allowed. The reason for that was some of the items that we purchase are not fully utilized in the year that we apply them. For example, we do not know that nitrogen is used in the year that we apply it pretty heavily, extensively. The only time it's left over is when, for some reason, we have a situation where the plant can't utilize it, drought scenarios, etc. Then we know that P and K have a longer period, so phosphorus, potassium, and some of our other nutrients that we put on, or soil conditioners, lime, marl, etc., also have an extended life. So what the guidance that came out, and this was early on, that the farmer may allocate a portion of the purchase price of land that has residual fertility on that property. That's our unused amounts. They can allocate a portion of that purchase price to that residual fertilizer. That's unused. And so when you look at what happens here, and the reason this has become very much popular in the press, is a few years ago, a group of, I guess, of crop consultants looked at how much fertility was in some of the soils over a period of time and realized that we may be missing an opportunity. So what happened then was these companies started working with producers, and the claim is that residual fertilizer on land that we purchase increases the cost of that property because we're willing to pay a little more for the fertility. Now, the question that often comes up, how do we know this? So what these companies have also said, well, if we can, that fertility increases the cost. If we do things properly and we can get a deduction for some of that, we can lower the cost of the land and get a deduction on the tax return for this excess fertility. Now the question comes up, when do you get to take that? So we'll look at that in a little moment. If we don't place a value on the residual fertilizer, that cost of the land becomes what I use the term locked into the property's basis, but what happens is if we don't claim it in the year of purchase, or we can go back and amend it up to 3 years, And we come back and place a value on that fertility. Again, that's residual excess. Then we can deduct it. If not, the property's tax basis is what we paid for the property in whole. So we don't lose that value of excess fertility. We just don't get to take an immediate deduction. And this is where some of these promoters are coming back to. Some of the promoters that I've found over the past several years include CropQuest. There's an Ag Soil Management Group. There's BOA Safra Ag. These are out of various states. BOA Safra is actually, I believe, out of Iowa. Ag Soil Management's out of Illinois. CropQuest is kind of all over. There's also a Crop Intelligence Group out of Iowa as well. So what you'll notice and what I've been receiving and as I work with folks around the country, if you look at the states that are getting a lot of activity, that's being Illinois, Iowa, Ohio, Indiana. Those that are getting a little more activities with Missouri, Nebraska. Kansas has quite a bit, and the Carolinas has quite a bit. So this is not just something that's Oklahoma. Oklahoma, like I said, over the last really about a year, is when I've been starting getting some of these questions. And there was enough questions that popped up last year that I presented this information of treatment for residual fertility to the tax preparers that attend my tax schools. And that was about 900 folks. So it's being made aware of. So again, why this is occurring? Well, the IRS guidance says the farmer can allocate a portion of that purchase price for a piece of land. That's at residual fertility in the soil. Those prior unused amounts. So this is IRS guidance. It says it allows it. Now the question is, can we abuse it? So the claim that the companies are using to increase the cost of land, valuing that residual fertilizers lowers the cost, no value, it's locked in basis. Therefore, here's what's happening. Companies are contacting farmers and providing the following information. It's also being touted in the popular press. There's been YouTube videos. John Deere has put some things on their website, Farm Credit East, and others. So what they're touting is a tax break exists that you may qualify for. Now here comes the rub. And some of the companies are saying if you purchased or inherited farmland within the last 15 to 20 years, you may qualify for this tax deduction. But you've got to be able to prove those residual nutrients found on your farm or ranch. That 15 to 20 years is where I have a problem with this. If you look at the IRS rules, you can change or amend a return no more than 3 prior years. They're saying you can go back 15 to 20 years. That's going to be pushing the envelope quite a bit. And I'll explain to you what the consequences may be if we buy into that. Another piece that the companies are touting. Our clients, this was an actual quote in one of their materials. The nutrient loads are over $1,300 per acre, resulting in a significant tax savings when they work with us. Now, what I'm curious about is what those nutrient levels were and what they were valued at. These companies are also stating that such process can be applied to pasture, and they're stating improved pastures and native range. Now, when I was in college, which has been a few years ago, native range was never really fertilized. Consequently, these companies are saying it applies to native range. I don't think so. I'm having a hard time wrapping my hands around, getting my head wrapped around the idea that it can apply to improved pastures. But that's what they're touting in their advertisements. So 15 to 20 years. I've talked to some of these companies that say, no, we're not going back that far. We're actually using the IRS code and saying it's 2 to 3 years. Again, this is what's being touted. This is what's catching the farmers' eyes. This is why they're getting interested in this. Now, where did this come from in the more recent years? And why is it really popping up here recently? There was a IRS, what they call a technical advice memorandum. What this is information that the IRS published and provided to preparers to, again, help point out what we're looking at when we're dealing with the idea of this excess or residual fertilizer. And the IRS, this technical advice memorandum says a farmer can amortize. What does that mean? Well, we get a deduction in each year that we can prove that the amount of that residual fertilizer is being utilized. So in order to do this, we have to get or establish the presence and extent of the fertility. So it has to be proven that it's there. So we're looking at really P and K. There's been a couple instances where we had nitrogen that was in excess, but again, that's going to be used up fairly quickly. And so it was more often than not just looking at P and K as the two primary pieces. And so the establishment of the presence and how much is there. And we have to be able to show how much that soil fertility level was for the previous owner. How much did they apply? So that means we have to have a soil test. And if you're looking at when that needs to be done, it needs to be done immediately after that property is purchased. Or if it's an inheritance, it needs to be done immediately before that property goes through the estate, or immediately after, right then when it occurs. So we have to show the amount, the type of that soil fertility, and then we have to apply and determine what the value is. And that's not easy to do either. Depending upon what it is and how long it may have been there, this is where these companies are saying, well, we can figure that out. I don't know how far back. I don't feel comfortable going back more than about 3 years to determine what our fertilizer prices were. And then we got to measure, get a basis upon which to measure the increase in that fertility in the soil. This comes back to those same soil tests. We have to then look at what would be a normal usage by a various crop. So this is where we're going to have to get not only a soil test done, we're going to have to consult with a crop advisor, an agronomist, somebody that knows how to apply this process to how the plants will utilize it, how long it will remain in the soil, or how much will be extracted in the first year, how much gets extracted in the second year, and so forth. And then we've got to provide evidence indicating the period over which the fertility attributed to that will be exhausted. Again, the agronomist needs to be looking at this. We're looking at, again, how fast does the crop utilize it? How much is really there? Will that crop utilize it? Or will it remain as excess or residual even after several years? And we have to be able to show there's a decline in that residual fertilizer supply. So we don't get to amortize or reduce from our tax bill that cost of the residual fertilizer until we can meet all 5 of these requirements. Remember, all 5 must be met in order to get a deduction in the current year and in future years. Some of these companies are saying, oh, we can get all of this up front. No, that's not the case. So under the, again, further indulgence in here, the right set of facts have to be in place. So in order for the purchaser to be able to do this, IRS does allow it, allocate part of that purchase price to residual fertilizer. Again, it has to be amortized, has to be over a period of time that we can prove that that fertilizer will be exhausted. And we have to prove that the person that bought it has beneficial ownership. In other words, they really bought it. They're not renting it to somebody else. The moment we rent that property, this set of rules does not apply. It has to be the purchaser, and they have to be utilizing that residual fertilizer. We have to show the presence and extent of that, which we just talked about. How much, whether it was for the previous owner. Then if we apply fertilizer as a current owner, we have to make sure that we have that ability to measure how, or keep track of how much was that we applied, and then how much of the residual is used up. If we apply more than what is utilized, then we don't get a deduction in that year. So again, it's more than just a very simple measure and a simple means of determining this. We're going to have to do some work. We have to measure the increase in the fertility. And one of the things that it says here must be no incentive to over fertilize. That's in the IRS rules. Now, my opinion on that is I don't know a farmer that has any incentive to over fertilize. And if they're truly trying to sell it and they're trying to do that to increase the fertility levels, I think it's kind of risky. They might not get paid for that. So I don't think there is an incentive, but the rules state there must be no incentive for the seller to over fertilize that property prior to the sale of that land or the prior to the exchange. And then there has to be a known period of exhaustion of that residual fertilizer. How long will it last? And some of this we do know with P and K. Now, here's what, like I said, the problems with the promoters. They're saying we can actually take a deduction on purchased or inherited land 15 to 20 years ago. Some of them are even saying doesn't even need a soil test. I don't know how they can pull that off. And I really don't know how they're going to be able to find soil tests back that far, but they may be able to. I know some of these states have had um, farm management groups that do work with farmers, and they've been working with them for a lot of years. I still have a question whether or not we can pull it off. 2 to 3, probably. Last year, definitely. They're also touting, and this is what I find is a problem, is they're saying not only P and K is valid, but also the micronutrients. Now, when I took classes in agronomy, some of those micronutrients are there in the soil and will never get depleted. They're there. They're going to be there. These companies are saying we can put a value to those, and we can also take a deduction for those items. After talking to some agronomists, some others, I don't think this is something we can hang our hat on. I don't think this is something the farmer can hang their hat on. But again, these companies are touting this. They're also as pay for their services. So when they come out, they're not doing this for free. They want a portion of the tax savings. How much of that portion is depends upon the company. And I have not seen anything in the contracts, but some of these companies, it's a fairly sizable percentage of the tax savings that they're wanting to be paid for this service. And some of that is not necessarily what you actually get on your tax return, but what they think the value of that will be on your tax return. Most companies, they're not going to file the tax return for you. Once you pay them, they walk away and you never hear from them again. Some of the costs that they're touting, $40 per acre for the testing. They're doing a very massive soil test. A situation that I ran into just here recently. A farmer called another person like myself in Ohio, and the company said, "We'd like you to take some soil samples, a minimum number. Let's find out if it's worth our time to come out and do an extensive sampling of your farm." Their cost for this was $40 per acre when they came out and did the extensive sampling. That allows them to get a better idea for determining those residual fertilizer and micronutrients. So $40 an acre, that's a pretty stiff number. And then they may still want part of the potential tax savings. One of the very interesting things that I read through on one of the flyers that I actually received secondhand from one of these companies, saying that they're using the tax code that allows a deduction just like depreciation. Well, this is code section 180 of the tax code. And that has nothing to do with depreciation, deductions for anything other than, they were talking about tile lines. It only has, or is only applicable to residual fertility. So when these companies are touting, oh yeah, you can take a deduction here just like depreciation. No, that's incorrect. So what happens if the IRS challenges his position taken on a tax return? So far, these companies have been doing this. I'm not sure how many tax returns have been filed. And I do know the IRS is understaffed, but this still can happen. If the IRS challenges the position that a farmer takes on the return, The penalty can be between or assess a 20 to 40% penalty on underpayment of the tax. And if they find this thing to be fraudulent, which in my opinion could happen, especially when we're talking about these micronutrients, there is a 75% penalty for civil fraud. This is from the IRS level. Now, state penalties can accrue. And what's interesting here, the state of Minnesota, their Department of Revenue, so the Minnesota's Department of Revenue, every time one of these shows up in one of their state returns, they immediately kick it out. They don't allow it. IRS hasn't challenged it yet, but in Minnesota, they're kicking every one of them out, not allowing them. So it'd be interesting to see how many other states and what they'll do. But that is what I do know is occurring. So that's what the big risk is. Now, so if a farmer wants to use this provision, what do they need to do? They need to get an expert analysis. They need to work with a soil scientist. Hopefully they're working with an OSU soil scientist, get an unbiased information of the soil test. What are the nutrient levels there? And are they in excess of standard or baseline levels? And can we prove that they were to the prior owner? We have to demonstrate through those experts that excess fertility has a useful life that is being depleted or will being depleted or exhausted over a certain period of time. Generally, you want to think of somewhere around 2 to 7 years in the agronomists that I've talked to. Some said it's very seldom do we see it being utilized in the first year, but generally 2 to 7 is a common. If these companies are telling, oh, we can get this within a couple of years or the first year, they're again being unreasonable in their assumption there, and I'm not sure the farmer should buy in. So also a farmer needs to be consistent in the approach. If they do this, the deduction for excess fertility, it has to be reflected in the amount of fertilizer or must be reflected and adjusted. That should have been in there, adjusted by the amount of fertilizer applied in that current year, crop year. Because if we're using residual and we're adding to that, we have to really look at how much of this is being exhausted. If you're truly trying to do this properly, you'd want to exhaust only the amount of that residual fertilizer or deduct that amount of the residual fertilizers that is actually declined. And then we also have to be diligent in reviewing and submitting data provided by these consultants. Again, want to look at what they're telling us very closely. You probably want to get a second opinion. Talk to an agronomist, an OSU agronomist. Talk to you as a county extension ag educator, making sure that is this realistic? If not, then we need to be doing something a little different. So, what should we be doing? So, they've been contacting us. Like I said, I've been reached out by companies contacted me. I've been contacted by tax preparers, some of our county educators in Oklahoma. I was actually, Dr. Warren was contacted by a tax preparer, a farmer in another state. So we're getting information on this. So other states are seeking, or these companies are seeking hosts for meetings. Do you want to do this? Our administration, so Dr. Warren and I discussed this. We're taking kind of I don't know, like belt and suspenders type approach. Live safely. I would strongly urge you to avoid working with or assisting these promoters. One of the problems that I see is we don't know what they will actually say during the meeting, and we know what's realistic, but we don't know and have any control over what they say. So I feel like we don't want to be involved in this if we can avoid it. There's a strong potential for abuse, and the farmer, taxpayer there, may pay the ultimate price. If these things are audited, remember those penalties and that I just mentioned, they do exist. They are in the tax code. The IRS can levy that, and those are severe. So, if you have a farmer walking in, make sure that they really think this over. If you're contacted, like I said, do not, I personally urge you not to host any of these programs. I have yet to find one that's 100% accurate. The one I talked to last week, they are closer than any of the others that I've found, but I still kind of wonder what's in the rest of the information they provide. They weren't willing to share that with me. When a farmer contacts you and you have, or you're uncomfortable, or you don't want to go any further than that, please feel free to have them call me, contact me, email me. I'll be happy to discuss this with them. Like I said, I've discussed this with several farmers, several here in Oklahoma, a couple from Kansas, explaining exactly what they're talking about and the rules, procedures, and what they have to have in place. Again, there's a lot of confusion being created with this issue of residual fertilizer. And I mean a lot. Like I said, if they come up to you and ask questions, um, please have them contact me. Here are my contact information, my email and my phone number. Do not hesitate to have them call me or email me. Probably email is the best. Also, Brent asked me to put the link to the webinar survey. Here it is. At this time, let's talk about, or let's, if you have any questions, let's air those. So let's open this up, Brent, and they got questions. Let's fire away.
There is one question already. Jason Warren asked, what if we have a crop share rental agreement? How would this affect things?
So you have to be the beneficial owner. And if you are on a crop share, it is the tenant that's probably getting the greatest benefit here. It will not work. Everything I've found that says renting immediately throws this out. And it doesn't matter what type of rental arrangement it is. That's a great question. That was one of the big problems that we ran into. They're talking about the beneficial owner, and that's is the terminology or the wording in the tax code and in that technical advice memorandum. Beneficial owner, that means the person that has the direct benefit of that excess soil fertility residual. Other questions?
And I have set it where participants can unmute themselves to ask questions.
Okay.
Hey,
Or that
JC, this is Jason. Um, one thing that you talked to me about was how it affects the capital gains. Can you kind of tell the educators or everybody what you told me about, like, say you get this $1,300 tax deduction and
Okay.
you
Okay.
pay
Let's go a little further.
$2,600 for that land, then they're going to dink you with the capital gains on that 1,300, right?
Right. Let's make this a little make it real simple here. So we purchase this piece of property and we pay, say, let's use $2,000 to make life simple from the math point of view. So we pay $2,000 for this piece of farmland. We do the we check the fertility as we buy it, and we find out there's about $600 worth of residual fertilizer. Now, as Dr. Warren pointed out, if we purchase this for $2,000 an acre and we do not take a deduction for the residual fertilizer, that $2,000 an acre is what becomes our tax basis. And over the years, if we hold this property and later decide to sell it, let's say we hold it 10 years and we don't want this property anymore, and we sell it for $3,000 an acre. We have $1,000 of capital gain income that's taxed at the preferential rates of either 0 or 15%. So we just kick the can down the road. Instead of getting an immediate deduction for that $600 of fertility, we get a deduction later when we sell it. That 15% of the $1,000, that's again 150. So you're not getting quite all of it back, but you get it's there. Now, let's look at the residual fertilizer issue of we're going to deduct that as it's utilized. So we take the value of the property, we pay $2,000, there's $600 of residual fertility. So now our basis in the land that we use to carry forward for capital gain is $1,400. When we sell it in 10 years, our capital gain calculation would be off of 1,600, not 1,000 in that previous example. But the difference is we have that $600 of fertility, excess or residual fertility, that we're going to take a deduction on. And we can prove that next year, the year or first income tax year that we actually farming the land and we're taking a deduction for that fertility, excess fertility, we take off $100 that year. Let's say we use up $200 residual fertility in the second year, and in the third year we use up the remaining $300. So we get an actual tax deduction from ordinary income in years 1, 2, and 3. So instead of kicking the can down the road 10 years, we actually get a reduction in our income tax in years 1, 2, and 3. And that's where this thing is coming in. Is the farmer buying this property to resell? If it's going to be held on for generations, he'd probably rather have it as a deduction, because if he never sells it, it goes to, and his kids inherit it, or the next generation inherits, we get a step up basis, and we just kick that can even further down the road. So there's where the difference is. These folks are saying you can get an immediate deduction today as ordinary tax breaks, ordinary income reduction, versus if you leave it in the land and we have to later utilize either a sale or something else in order to capture that benefit. So again, this is another one of the promoters' reasons for doing this. We're trying to prove to folks, take it now versus later. And that's what becomes appealing.
So a couple more questions came in while you're answering the last question. The first question is residual fertilizer the fertility above the first year's crop? That was from Rick Clovis.
Okay, here's where the residual fertilizer comes in. And I probably didn't make this clear enough. So the farmer, the original owner, he's harvests his crops, and now we're going to sell the land. What residual fertilizer would be is the amount of soil fertility that exists after that crop is pulled off. Now, here's a scenario that I questioned or wondered about, but I don't have anybody that's able to answer this yet. We don't know. It's not been tested. My question is this. So the farmer harvests his wheat crop in June, and in July he starts preparing, and by the end of the before the end of the year, he says, I want to sell this thing. As long as he hasn't applied any fertilizer, I think that'll stand up as being residual. Now, if he plants the crop, and let's say we sell this in November, some of that fertility is utilized. This is where the agronomist is going to have to come in and do a little work for us. I think we can come up with a number that we can attribute to what that growing wheat crop is at that point in time, to come up with what the residual would be after that point in time. But that's one of the questions that I had. There was another gentleman that asked the same question, and nobody within the tax world has been able to give us an answer. So that one I don't know. But to answer your question, we're looking at, yes, after that crop is harvested, before we apply anymore, that becomes the residual amount that's there. That's why that soil test is necessary. Hope that answered the question the best I could do.
And then the next question is, what is the role of extension if producers ask for interpretation of soil tests through company XYZ versus the OSU lab results?
I don't think there's a problem. Now, Dr. Warren may have a different idea. If it's on a soil test, I don't think we have any problem. Those companies have to stand behind it, because the two companies that I've talked to, they do not do their own soil testing. They're sending those off to others to do the soil testing. They're using commercial labs. They're using universities. Others that will hang their hat and say, yes, this number does exist. This is quantifiable. I'm not seeing any of these companies that are doing their own soil tests at this time when it comes to this residual fertilizer. I think they're trying to avoid any issue where there's potential liability back to them.
That would be one of the things that that I think about when I listen to JC talk about this is if you have an entity who is charging a farmer money for a service to generate data that they can take to their tax preparer to get this deduction, and that entity has no liability in the event that the IRS audits this, I wouldn't touch it with a 10-foot pole. That contract as a landowner, I would not sign a contract with a company who tells me they're going to generate data that I can use with my taxes, and then in the event I get audited and what they did was insufficient, they have no liability. For one thing, I wouldn't sign that contract. And then, and two, there is basis for this. I mean, you can, but the problem is the diversity of soil fertility inherent in our soils or anywhere in the country is very much different. So you can't just use a soil test P of 70 and say that's residual fertilizer over a an inherent value, because some of our soils, like in north central Oklahoma, you'll have inherent soil K values of 500 part per million, and you can farm them for 30 years and not get them to draw down. And I have not studied the soil science behind this, but it's not simple.
Thank you for your comments there. You're exactly right. And that's kind of my feeling. If they're not willing to sign or stand behind you, it is time to run. Other questions?
I also wanted to remind everyone that I did share the link to the webinar survey in the chat window as well.
And if you come up with other questions, things to think about, please reach out to me. I will do my best to get back to you and provide you some input, point you in the right directions. But again, this thing is big, it's growing, and there's a lot of dollars being at stake here. And it would be wonderful to make sure everybody's on the same page and everything was correct. So with that, Brent, if there's no more questions, I'll turn it over to you.
Okay, thank you, JC, for presenting today.
Thanks, Dr. Warren, for your comments. Greatly appreciated. And the reminders that of other topics or other things that you and I talked about.
Yeah,
Thank you.
I don't see any other questions, so I wanted to remind everyone that our next webinar will be April 16th over enterprise budgets. So hopefully we'll see you there. And so I'm going to go ahead and end the webinar now.
Thank you.